Of course, a lot of the focus from the street is going to be on inflation, some of those inflationary pressures that maybe we could see here in the coming weeks. I'm curious whether or not you agree with the sentiment that those inflationary pressures are well anchored at this point.
So that's a very good question. I mean, I think we saw some fairly disturbing data from the University of Michigan on Friday, and I was taking a look at sort of like where the sources of all these concerns about inflation expectations rising come from, and it really sort of rests along the political divide. Republicans think inflation will literally be zero in the next year, and Democrats, it's like 4.5% or 5%, something like that. The middle is kind of bouncing around. That looks to me like it is getting to the point where it's arguably unanchored. It's at least like sort of a subsection of the population has become very unanchored, right? And that does influence behavior and economic decisions and whatnot. So it could be an issue that they need to keep an eye on, but there's not a whole lot they can really do about it at this point.
How does that data that you mentioned set up Powell heading into his remarks today as he tries to paint a narrative of success from the Fed in front of the Senate, given that he just had this challenging data backdrop? Is that going to make things more challenging for him?
No, I mean, I think that he's actually done pretty well to sort of set this up in some of his recent comments. Back when the Fed really accelerated their pace of hikes back in June of 2022, I think it was, he cited long-term inflation expectations in the University of Michigan survey as one of the things that said, all right, we got to go 75 basis points a meeting. Since that time, he's specifically sort of dropped the reference to that particular survey, and now it's like, all right, well, some expectations are rising, but data from the Conference Board and their consumer confidence survey, that doesn't quite show the same type of thing. There's still stability in market-based measures like TIPS break-evens and things like that. They've drifted higher a little bit, but I don't think that they're in the zone that's really particularly concerning that policy is, sort of misappropriated.
What do you think the policy path should look like going forward, given what we know? Obviously, there's so many unknowns out there, but just Powell's comments, he's not in a rush. That very much seems to be consensus at this point. I guess we talk about the tipping point, right, or what they need to see in order to feel comfortable to potentially cut again. What does that look like?
So I think they do need inflation to be broadly much closer to 2%. They are going to get some help, I think, with that in the next couple of months. Early last year is when we had a lot of the inflation sort of pressure that was surprising to the upside. They probably need to see some labor market data weaken a little bit to give them really the strongest motivation to cut, more than maybe one more time. But the initial way you asked the question was like, what should they do, right? I think
it's hard.
It's a little bit of a loaded question, but I think that they really need to get away from this concept that there's an individual neutral Fed funds rate and that the gap is really particularly meaningful because, I don't know, we can talk all afternoon about this, but there's a number of different things that we've seen or we didn't see that we expected in the tightening. I think that's because of a lack of sensitivity there, and thus the framework might not be as useful as it was.
That's really interesting because it makes me wonder how much power he has in his ability to shift the market with the things that he says in front of the Senate. For example, today, is it enough to kind of spook the market into thinking he may not cut, or does he have to spook people enough to think he might hike? How do you think about that relationship?
I think, there definitely is a game going on right now where it's all about managing expectations rather than needing to adjust rates one direction or the other, right? Like 50 basis points plus or minus here or there is not going to, throw sand in the gears of the economy. As a consequence, they cut 100 basis points. I think that they have characterized that ex post as like some sort of insurance policy. Now it's guidance that something else could happen as sort of like their next insurance policy that is actually a little bit cheaper because it doesn't require a whole lot of action. So it's a difficult path to go down, but also I think there is some comfort in the fact that policy right now, since it isn't having, at least in my view, such a strong impact on actual things going on in the economy right now, it means that the risk of being wrong with policy is actually somewhat lessened, right?
What's your assessment of the U.S. economy?
I think it's in the aggregate in very good shape, right? I think that the economy is more sort of heterogeneous than it has been in probably decades in terms of like some sectors doing better than others. Manufacturing outside of AI and electricity infrastructure investments are quite weak. There's individual big manufacturers that have problems with some of their products that fly in the sky. And the housing sector is a mess too. But consumer demand still looks pretty good. I think that a lot of the concern about the aggregate credit numbers is a little bit overblown. And again, obviously, just because you look at the amount of, say, credit card debt that's out there on any, over time, right? It is an up and to the right chart, right? It actually flattened fairly significantly during the pandemic when a bunch of people were able to pay off their credit cards. There's another metric that I look at from the Philadelphia Fed that shows the percentage of people who pay off their balance every month. That at a level shift in 2021 or 2022, one of the big stimulus check payments, that went from 36% to 38%, right? And you can, I think, on one hand, look at that and say, like, that's almost nothing, right? But it didn't go back down, right? And I think that that's actually a sign of, like, really healthy balance sheet for households. Being able to pay off credit card debt and not continually pay interest is like the first step towards anybody actually getting out from under debt and then, having wealth creation be possible, right? So that and the fact that the economy hasn't actually slowed alongside most of these deteriorating credit metrics, we could see many years from now with revised data, maybe it doesn't look quite as good. But from where I sit right now with what I see, I'm not as worried about it.
And given that kind of resilient picture you paint towards monetary policy, is the same true when it comes to fiscal policy and what we might see when it comes to tariffs?
Yeah, well, I mean, this is a really difficult question because the way that the administration talks about tariffs and their relation to revenue generation, revenue collection is frankly just not realistic, right? And also the policy has been very inconsistently applied even in the last 3 weeks of the first 3 weeks of the administration. So I don't think that it's something they can really factor into their models as sort of like what they're expecting revenue to be and thus how much they can increase spending. I think we're like a long way away from having settlement on this fiscal issue. Even just now looking at headlines about this sort of like right hand not talking to the left within the Republican Party in Congress, the House going one way and the Senate going with another approach. It just seems to me that it's going to get messy before it gets better.
Thomas, how much focus are you still placing? Are you placing much emphasis on the labor market at all at this point?
Well, I mean, I'm carefully watching it to make sure it doesn't deteriorate. Right. I don't think that there's some sort of like crack forming or some shoe to drop necessarily. Every time I've expected that something like initial jobless claims are going to go up, they either go up less than I thought or they stay quite low. So layoff activity is still pretty sluggish. And so long as that's the case, I think that means that there's some good stability in the labor market, even if it is more difficult to get a job if you're entering the labor market now.
Forgive me for asking this, but the wage growth number from Friday, is there any chance that there's too much growth happening right now? Is that a potential risk that we're not talking about enough?
I don't think we're quite there yet. I think you could actually make some arguments that was a little bit of a technical quirk, like the work week fell a little bit, right? I always think that data is funny because we obsess over these like 0.1, 0.2s. It's really like 6 minutes of work over the course of a whole week, right? And anyways, it does tend to amplify some increases in the average hourly earnings number. So like if the work week were steady, it probably would have been somewhere closer to 0.3%. And when you consider that January is typically a month when a lot of labor contracts are renegotiated and a lot of prices change, something we'll see in the CPI data tomorrow, I'm sure. To me, January has a relatively wide range around it where I kind of take signal from that. So I would be very surprised if we saw something like that strong again in February.